And this drove the divergence between paper gold and physical gold to the extremes actually not seen since March 2020.
Let's start off with a review of what you're seeing in the ongoing paper to physical war, I guess we would call it now. And this was a long before the Russia conflict began. And to answer a huge amount of requests that we're getting, can you first start off by picking up on the thread that we had 2 weeks ago?
Yeah, great to see you, Shane, and great to be with everybody. I really think it's so important that we take this look at this different look at the market, and obviously we'll really try and bring you up to speed because there's a lot of stuff going on. And but you mentioned the war. Well, I mean, there is an officially driven PSYOP war on gold, and we looked at the PSYOPs, and obviously I know most people know what PSYOPs is. It's a legitimate thing. It's a tactic, and it is usually a war tactic. But obviously, look on Wikipedia, and you'll see a really good, decent idea of what it is. But this PSYOP war on gold, it really ramped up this last couple of weeks, actually, and this drove the divergence between paper gold and physical gold to the extremes actually not seen since March 2020. And our focus has been on the backwardated EFPs. Now, look, we talked about backwardation. Backwardation is simple. It is simply when you have a futures price that is actually lower than the spot price, i.e., so that should not happen, and that happens only in a case of when it's oversold. And EFPs are the exchange for physical mechanisms, which we've described many times, which essentially is the Comex price then transiting over to the spot markets in London and the globe. Now, what we're saying is this is where our focus is, because it's the Achilles heel, and it's dangerously close again since March 2020, the first time since March 2020, where it's driving out liquidity providers. And once again, these providers are very concerned that they're going to get caught holding the bag in a March 2020 EFP blow up.
Now, Andrew, we've had a lot of incoming questions about the current paper market volatility. It's up and down like a yo-yo. We just had mentioned this too. Can you just tell us what you think is going on in not only the short term, but the medium and also the long term here?
Yeah, really important, especially when you've got this kind of level of volatility, which is designed to provide volatility. In fact, the Comex was initially 50 years ago designed to import volatility and also dilution. So there's no other reason for this market to be operating the way it is. A legitimate futures market is a necessary item. If you're a corn, if you grow corn and you need to know what your pricing is at the end of the year, it's legitimate to be hedging it. It's a useful instrument. But when you start to play games with futures contracts, it's no longer a legitimate instrument. And so let's step back. I think it's always best to step back for a millisecond to look at what we just described, this March 2020 event. Because it's so highly relevant now. And obviously we looked at it, goodness me, in an earlier episode back in March 2020, we looked in detail as in live time, what was happening, and over the months, how that played out. But this was essentially when liquidity providers, which is these are the liquidity providers who are long spot gold, not in the Comex, but long spot gold on behalf of clients. Now, what that is a foreign exchange cross between gold and the dollar. So you're either, if you're long gold, you're short the dollar, and if you're long the dollar, you're short gold. But in this case, we're talking about speculators who come in to buy spot gold for various reasons, and maybe to speculate on a higher price because it seems cheap. But so essentially, so when a liquidity provider purchases this on behalf of a client, they were able, when providing these longs to speculators and traders, to get away with trusting the short Comex futures market, which again are unbacked. So you've got unbacked and unbacked. And so these are paper hedges. So the Comex is a paper hedge to these longs. So to offset these unbacked paper spot gold liabilities, so in other words, what they were doing is the spot gold trade was being structured really just like any other foreign exchange trade, which could be dollar, it could be dollar euro, it could be anything else. And they structure it in any way, which in the same way as any other FX trade, which necessitates some form of hedge to be implemented by market makers and the takers. So obviously you're trying to make a market, you're not trying to take a risk. But this is the key thing. Unlike any other paper-to-paper FX trade, which is what we just described, for the last 50 years, ever since the Comex was formed to manage, and that is to dilute, a carefully balanced paper-to-physical dislocation between real supply and demand, these long spot gold credit positions have always posed a risk to these liquidity providers, providing these leveraged gold credit positions, because that's purely what they're providing, not physical gold credit positions, in so much as they could be called on for physical delivery. Fear the worst that this may happen. And that's precisely what happened in March 2020. A shortage of physical caused by COVID refiner lockdowns at that time caused such a starvation of physical supply into strong safe haven physical demand that buyers turned en masse on these market making liquidity providers to demand T+2 delivery, i.e. I want delivery. And so you put them on notice and you must receive delivery within 2 days, technically, or default. So you don't want to see a default. So in other words, they were demanding, they all turned en masse and said, give us this physical then. You're long, so you must have it. They didn't have it. And this exposed the paper-to-paper sham for what it really is. And for the first time in 50 years, it broke this exchange for physical Comex EFP mechanism. Don't get confused by these terms if you're new to it. This is just a simple exchange from a futures contract into a more deliverable over-the-counter market, which is where really the volume is. And this, by design, mirrors this 10 times larger, technically deliverable spot market. And of course, this has been the main tool to rig gold prices with these kind of smoke and mirrors tools. Now, while the first tier too big to fail agent banks were openly and officially bailed out from multi-billion-dollar losses when this happened, the second tier, and mostly Swiss and European second-tier banks, they were left to suck up the losses, which resulted in them exiting this space, which was extremely profitable once upon a time, and they've exited for good. So again, this is interesting because that's removed this degree of liquidity. And the reason I see this as very relevant now is that for a different reason than COVID, the backwardations signal that the physical to paper disconnect is once again threatening to blow up this insider's EFP hedging tool and expose these liquidity providers to another run. And while we looked last time at the COT report, which is the Comex report showing the biggest positions. Oh, goodness me. In a picosecond world, it's delayed by 3 solid days. It's really just a rigged mechanism. But as we said last time, this report, which gets published every Friday that reflects what happened on a Tuesday, they cannot hide the fact that the house, the casino, the insiders, are laying off as much short exposure as possible on the speculators. In other words, getting the speculators to take the risk. However, there are only so many chips that you can put into play before the scam becomes too obvious, even to the siloed Comex speculators. Now, given that since January 22 of this year, net stable funding ratio standards now force the remaining liquidity providers to have bullion to back up these over-the-counter gold credit positions. And that's, of course, as we've described before, net of what they can flywheel into this scam of the GLD ETF, the ETF which is labeled GLD, because that's not 100% Basel III compliant. And what the wholesale footprints evidence, this is clearly not compliant. And it indicates that officials, though, are right now the ones providing a put under the agent bank short sellers. Now, normally we've looked at a put under the stock market that the Fed has provided. But in this case, it's quite clear that they're incentivizing short sellers to come in, take the risk, and just providing them some sort of protection at the moment from getting rinsed on the upside at the moment, that is.